Self-employed business owners are constantly looking for legal ways to reduce their tax burden. One powerful strategy that many overlook is the S-corporation tax election. This approach can potentially save thousands in self-employment taxes each year while keeping you fully compliant with IRS rules. Self-employment tax covers Social Security and Medicare contributions. When you work for someone else, you and your employer each pay half of these taxes, totaling 15.3%. But self-employed individuals must pay both portions themselves. This tax applies to all net business earnings for sole proprietors and standard LLCs. This is where the S-corporation advantage comes in. An S-corporation is not actually a legal entity, but a tax classification that any LLC or corporation can elect with the IRS. The key difference is how owner compensation is taxed. In an S-corporation, business owners wear two hats. They are both employees and shareholders. As an employee, they receive a salary subject to employment taxes. As a shareholder, they can take additional profit as distributions. These distributions are not subject to self-employment taxes, though they still face income tax. Here's where the savings happen. If you earn $100,000 in your business as a sole proprietor, you would pay self-employment tax on the entire amount. But as an S-corp owner, you might pay yourself a $60,000 salary and take $40,000 as distributions. You would only pay employment taxes on the $60,000, potentially saving over $6,000 in taxes. However, the IRS has established rules to prevent abuse of this strategy. You must pay yourself a reasonable salary before taking distributions. Reasonable compensation means what someone in your position, with your experience, in your industry and location would typically earn. Setting an artificially low salary to maximize distributions will raise red flags with the IRS. To determine if this strategy makes sense for your business, consider your profit levels. The S-corporation election typically becomes beneficial when business profits exceed $50,000 to $70,000 annually. Below that threshold, the additional costs may outweigh the tax benefits. Speaking of costs, electing S-corporation status does create additional administrative responsibilities. You must establish a formal payroll system, file additional tax forms including Form 1120S, issue K-1 forms to shareholders, and maintain proper corporate records. Many business owners hire accountants to handle these requirements. Certain industries benefit more from S-corporation status than others. Service-based businesses like consultants, freelancers, marketers, and professional practices often see the greatest advantage because they typically have high profit margins with minimal overhead. Common mistakes to avoid include underpaying yourself, mixing personal and business funds, ignoring payroll filing requirements, and failing to track business expenses properly. Each of these errors can trigger IRS scrutiny and potentially costly penalties. The S-corporation tax strategy represents a legitimate way for successful self-employed individuals to reduce their tax burden. By properly balancing salary and distributions while maintaining compliance with IRS regulations, business owners can save significantly on self-employment taxes while building a more sophisticated business structure.